Hey, Bulls and Bears, it's JJ. You're watching Bull, Boom, Bear, Bust. This is our Saturday, January 14th, 2023 economic financial news update. We've got a lot of news to get into today. And as usual, it's very strange how things are being reported. So we're going to dig into it and kind of dissect things for you here. But first of all, where do we stand? Well, we know that something big is brewing within the banking system. And it's really no surprise, but at least we have evidence here more recently with FDIC coming out in this meeting. And I talked about this in a couple previous reports. But sometimes if I don't repeat it, several episodes in a row, people that didn't see those reports think that I just missed it or didn't know about it. But I want to kind of touch on that again today and go into some other news related to that and the overall economy. Now, the FDIC, for those of you that didn't know, they're out there talking about how they're going to make a big announcement to the public. And they're talking about making the announcement on a Friday night. Now, if you know what FDIC does, then you know that this is pretty serious stuff that's going on behind the scenes. We don't know exactly, but we do know that they had a meeting, that they are discussing within those inner confines how to break some news to the public. And obviously, if they're having a meeting about it, a closed door meeting, then there's probably something serious behind the scenes. Now, we know this already even before this meeting because we know the banking system is basically leveraged to the hilt. The banks don't have to have any money sitting there in reserves in order to give out loans. All right, so that's going to be the segue into our first news topic we're going to look at here today. This is unbelievable. Call it what you want. I mean, maybe it's going to be believable because we know how this operates. But I think a lot of people don't realize how much risk they may be in right now. Now, some people think that that there's not going to be bail-ins, and a bail-in is basically when they take depositors' money, and that's you and me. If you have your funds in a bank, you are a depositor, but you become an unsecured creditor once you give the money to the bank. It's in the fine print, all those forms and documents that you fill out when you open up a checking or savings account. You are an unsecured creditor to them, to the bank. Now, if FDIC does what they say they're supposed to do, they will protect up to $250,000 in deposits. So the bail-ins should only occur for people that have more than $250,000 in deposits within an institution. So a way you can kind of protect yourself, if you believe that's how the FDIC is going to end up handling it, the way you would protect yourself is put your funds in several different institutions if you have more than $250,000. Now, other people say it's going to be much more unfair or much more against the guidelines on what's going to happen. They say that they're going to bail in everybody, including people with less than $250,000. But let's talk about something about FDIC. And I did mention this also in a previous video, but I know not everybody watches every video. So if you didn't watch that particular report, you might have think I skipped over it. FDIC is insuring, and I'll put the quotation marks up here, insuring about $9 trillion worth of deposits or assets. They're insuring that with $125 billion. So obviously the numbers don't add up here. We know that most of these programs are basically insolvent. Yes, they can click a mouse and make the money out of thin air. At the time, they can create the money at that time for bailouts or whatever's needed. Of course, they don't want you to know that, because if you know that, then you know that there's really no justification for bail-ins. Why would they have to take depositors' money when they can just click a mouse and create the money, right? So the money's not backed by anything, but you're not supposed to know that. Even though they come out and talk about it in their own meetings, but it's not televised on the nightly news, so most people don't know about it. Right? So I don't really give advice on this channel, but do what you will with your funds. If you think they're safe in the institution, if you believe that the FDIC is going to have your back when this system goes down, when the banks go down, then more power to you. I hope you're correct. All right, but segue now. Speaking of numbers that don't add up, take a look at this article, and then we're going to talk about the real situation here. A recent news report here, big banks set aside $4 billion with a B, for a recession. Investors are more optimistic, morning brief. $4 billion. Now, think about that. Now, think about this. Just the credit card debt alone of U.S. consumers is close to $1 trillion. So there's another case of a complete mismatch, just as bad or worse than FDIC. We're insuring $1 trillion plus worth of debt that banks have given out or loaned out with $4 billion. But it's much worse than just $1 trillion credit card debt. Take a look. U.S. household debt total is now $16.5 trillion. That's trillion with a T. So big banks are setting aside $4 billion to cover 16 and a half or $16.5 trillion worth of debt. So obviously, again, the numbers don't add up. There's a mismatch here. And that's what is possible when you have this type of money that can be just created at the click of a mouse. Now, I see a lot of people say, don't trust the bank, don't keep any money in the bank. It's not that simple, though. How do you pay bills? I don't know anybody that pays all their bills just through the mail. So you send in your taxes through the mail, you make your insurance payment every month through the mail, or whatever it is every year. More people pay their bills online now and digitally than they do the old-fashioned way through the mail. So just getting out of the bank is not that simple. Yes, you can keep just enough money in there to pay the bills, but then you run the risk of overdrafting your account if you don't have enough money in there. So it's not an easy thing to say, get your money out of the banks. All right, but then again, on the flip side, some people say that they feel the safest having the money in the bank because they feel that FDIC and the insurance that is not insuring for enough or that doesn't have enough to cover the losses, some people still feel safer with that. Either way, please let me know what you think down below. Do you feel safer with your money in the bank, too big to fail bank that's always going to be bailed out, so therefore your money's always safe? Or do you think there's something very dangerous happening right now, and that's why FDIC is having these meetings? Now, speaking of dire warnings about the economy, people say I'm doom and gloom. Well, listen what Cathie Wood, quote, super investor, Cathie Wood, what she is warning against here, or warning about. Quote, the setup will be more like 1929. Cathie Wood has warned of another Great Depression if the Fed doesn't pivot. So in other words, there's so much debt out there that these interest rates that are actually not very high historically, even right now, but because they're much higher than they've been over the past 10 or 12 years, this is going to cause the next Great Depression. And yes, it's ultra low interest rates that got these bubbles blown up to these enormous proportions that we're seeing today. Home prices wouldn't be where they're at right now if it weren't for rock bottom interest rates. Car prices wouldn't be where they're at. The cost of living actually wouldn't be where it's at without these rock bottom interest rates that we've had for over a decade. So if a Fed pivot back to rock bottom interest rates is the solution and what's going to avoid a Great Depression or an economic collapse, then why did the Fed raise rates to begin with, right? So if rock bottom interest rates are the solution, why even raise rates? Why not keep them at zero to infinity? Well, that's because runaway inflation, right? So folks, they are between a rock and a hard place. And obviously the inflation is really not coming down significantly enough to help people because we still see the levels of debt increasing every month. If the cost of living was coming down, if inflation was really coming down noticeably, maybe debt would stop going up. But no, debt's still climbing because the cost of living is still climbing, even though the rate of inflation has slowed down some. And this whole thing, again, it's a house of cards. It's a Ponzi scheme based on borrowing, spending, banks lending, and then people pretending that everything is okay, that the economy's good. But all this, quote, economic growth that we've seen is just based on consumption and people taking on debt and buying things with money that they don't have. So when higher rates come along, making it more difficult to borrow and still meet that monthly payment, then this whole Ponzi scheme, starts coming to an end. And that's what we're seeing right now. And that's why you see warnings like this out of Cathie Wood. Now, on the topic still of ridiculous news headlines, and some people may even say insane, they quote Cathie Wood here as being a super investor. The super investor is sounding the alarm, not to take away from her warning. I think she's got a valid warning there against higher interest rates. But let's take a look at some of her returns in her fund and see if the name super investor is accurate. And let's just go back here just 1 year. She's down 56% in her ARK investment portfolio 3 years down 25%, 5 years down over 2%. So if you would have been with her for 5 years, you'd still be underwater. Now, if you started with her back, 10 years ago, and then got your money out before the market started going crazy, then you might have made some money. But I wouldn't classify this as a super investor. Would you? Please let me know down in the comments. And just look at some of the headlines that came out in the past year here. ARC's Cathie Wood continues to stumble. Cathie Wood feels investors' pain, foresees gains. Cathie Wood's flagship ARK fund suffers biggest monthly drop, and so forth and so on. Bloomberg article, U.S. banks see consumers piling on debt, boosting bottom lines. Yeah, boosting the banks' bottom lines, not the consumers. Dive into this a little bit more here. U.S. banks see tougher times ahead for consumers. That may not be so bad for the banks. Of course, the banks, they love it when consumers are in debt. When consumers carry balances from month to month, that's more interest that they can charge to those customers. What's bad for the consumer and what's bad for you and me is good for business, good for the bank. But here's where it gets even more interesting. The heads of the nation's four largest banks, JP Morgan, Bank of America, Wells Fargo, and Citi Group, took turns in calls Friday describing customers who are drawing down savings. That's the record low savings rate that we talked about here. Drawing down savings, piling on debt on credit cards, and a growing number of cases struggling to make their payments. So, folks, with everything happening now, even with the banks out there telling us that consumers are in big trouble, you really need to see, that things are not going to be okay. Hopefully, they'll be okay for us because we know this, but most of the population has no clue what's coming down the road. We're going to be prepared. We're going to be ahead of the curve on this, but we need to protect ourselves. It's going to get dangerous out there. We see where poverty increases, crime increases, more desperate people, more home break-ins, vehicle break-ins, more thefts, robberies, etc. So be careful out there. As always, keep stacking. We'll hopefully talk to you down in comments here. Thanks, everybody, for being here and keeping this channel alive. Hope everybody's having a good weekend, and we'll talk to you very soon. Keep stacking. Big love. Bye for now, and peace.